I think this has become a central demand from investors. Everybody has been surprised by the rise of volatility of 2008, and this has been something incredible, in fact. Each time the, for example, VIX index was crossing 30, 40, 50, 60, 80 points, people were really under the shock of this rise in volatility. And in fact, this has really created some significant imbalances in the allocations of clients, and they lost control of the risk of their portfolios for many of them, whatever the asset class. In fact, that's true for equities. Everybody knew for a long time that equities were risky investments, but however, they proved to be very risky in 2008. And for other sub-asset classes like credit, for example, in the fixed income area, asset-backed securities, mortgage-backed securities, for which people had a view that was quite conservative in terms of risk profile. In fact, they couldn't lose part of the interest that they were gaining, but in many cases they were not expecting losing in capital, and not at all at the expense of what was experienced in 2008. So here we have been products that have been losing 3 years, 4 years, 7 years of interest. So that was kind of a shock for the investment community as a whole, and it really requires a rethink of the global asset allocation approach and the way we monitor risks in portfolio. This is also particularly true for emerging market securities because they've been the worst performing sub-asset class in 2008. Though the recent rebound enabled them to compensate almost totally this underperformance, the peak to trough performance was very difficult to bear for investors on such a short period of time. So we now clearly need to think at new ways of monitoring and controlling the risk in portfolios, whether they are equity portfolios and even more when it's balanced portfolios, to make sure that the kind of drawdowns that those portfolios and allocation experienced in 2008, which impacted retail investors, corporates, private banks, and insurance investors, no one was immune from that it never happens again, and that at some time we have some mechanism in the processes of the management of products that protect investors from drawdowns of 30, 40, 50%. And I think this is really the major issue that the industry is facing. Similar for hedge funds. Nobody could expect hedge funds to lose 2 or 3 years of past income. So that was a major shock, and that has triggered a lot of thinking in the investment industry, both on the theoretical and mathematical part, trying to model portfolio, but also in changing investment process to make sure that managers are more reactive to the risk of maximum drawdown. I think we will insist even more than before on diversification. We will insist even more than before on investment horizon for products, and we will try to implement some procedures in the processes of investment management to make sure that the volatility of products remain under control and that does not reach the climax that we had in 2008. So it means that the products might be a bit less pure than they were before, or that they will be viewed less conservatively than before. But I think that it will be at the greatest benefit of investors to have some kind of safe nets that are going to prevent them from experiencing the kind of traumatism that happened last year. One of the messages that I'm trying to sending people here is that you need to really look at the volatility of your allocation, even if it's an equity product. It means that you need to have an appropriate either sector or country diversification. For example, the most appropriate investment solutions in the current context are funds that are related to the BRICS solutions, because you have a mix of country which, individually speaking, we like them, individually speaking, and they have some great advantages. But we think that it's not time, given the volatility of markets, to invest in those individual countries, but to take the advantage of mixing the four together, having some economies that are driven by materials, some economies that are driven by exports, because at some time it will recover, economies that are more oriented on domestic growth, the case of India, for example, economies that have current account deficits, but also current account surpluses, typically the case of China, that has, and this is kind of a unique example, the resources to fight by itself the slowdown and to boost significantly its growth level. So mixing those four countries together is for us the most appropriate investment vehicle for people who want to be invested in equities. For other investment solutions, we try to also propose clients solutions where we would reduce the investment in risky assets, would the level of volatility significantly increase in order to make sure that the risk level of the portfolio remain appropriate with the targets and interest of the investors. Quite obviously, ETFs have become increasingly popular over the past 4 or 5 years. You find very interesting investment solutions from ETF, in particular for the most liquid ones. Why it is interesting for investors to buy ETF? First, because they can buy an index without any bias if they want to close a position, if they want to reduce the tracking error of the portfolio versus their benchmark. So of course that's a very convenient tool in that objective. That's also, for the most liquid ones again, a way to put very quickly some money at work. And in the current circumstances, a lot of people had some cash in portfolios. And for example, if you look at the inflows in emerging markets, that's an example. We've been having some 8 billion of inflows in 2009, and the 2/3 of those inflows have been directed into ETF, because that was a very convenient way for people to put money at work, even if they had no idea on country allocation or on sector allocation. So in that perspective, that's appropriate. However, we know that long-term investors need to generate alpha on top of beta. So having some core products invested in ETF also help them to concentrate on where they can find alpha, track alpha, assess the quality of the managers that they select. However, there are still some need for some alpha, and this alpha will come from active management in most cases.